A few key stocks are setting record highs, while others are being left in the dust, leaving many investors questioning how long this can continue for and if a tipping point is soon approaching. In this video, I'm going to cover one such stock that recently received some troubling news, sending shares plummeting nearly 12%. Was this drop justified? And is this just the first of many falls that we should be expecting over the course of the next year? My name is Paul, and so far I've invested $100 per month into Canadian securities for 30 months straight, with the intention of emulating the journey of a hypothetical Canadian who will never be able to max out their tax-free savings account. And I'm doing this series to try and show that by following a disciplined plan of investing $100 every month, the average Canadian will be able to achieve retirement and live happily off of their investments in financial freedom. The company that dropped 12% in just 2 days is Canada's non-prime lender, Goeasy. And the reason it dropped was a huge shock, especially since the company had been a consistent high flyer that was up nearly 130% within the last 12 months or so. So what exactly caused this sell-off? Well, it was the company's unexpected announcement that the president and CEO, Jason Mullens, who had led the company since 2019 and oversaw the acquisition of LendCare, as well as the creation of the new mobile app, is going to be stepping down. Mullens had been a crucial figure in Goeasy's success. He was behind the addition of the automotive financing portion of the business and was key in building up a network of over 10,000 merchants that have partnered with Goeasy to offer point-of-sale financing for their products. All the while, the company has beat on earnings every single quarter under Mullens' leadership. So the announcement that he would be stepping down only a couple months after having mentioned his excitement about the creation of the company's new credit card product was a very unwelcome surprise to many of Goeasy's investors, who have seen share prices increase under Mullens by more than fourfold in his short 5-year tenure. This is why the company's shares have dropped from $205 into the low 180s in just a couple days, turning what would have been another great 1-month performance into about a 4.3% loss. Though thankfully I didn't purchase any shares last month, and I probably won't pick up any more this month either. Though if you're someone who's been sitting on the sidelines waiting for the stock to come down a bit before buying in, this could be a good opportunity to get some discounted shares, since Mullens isn't just up and leaving the company. He's still going to be staying on as president and CEO for the remainder of the year, and will be helping to find a replacement. Plus, even after he does step down, he will be staying on as a director of the company. So I think it's pretty reasonable to rule out any fraud or serious wrongdoing, since 99.9% of all companies the size of Goeasy would be rushing to sever any and all ties immediately if they found out that their CEO was engaging in unethical or illegal activity that could bring down regulatory hammers on them. Personally, if I had to speculate on why Mullens is stepping down, I'd guess that he either received a better opportunity at a bigger company or decided that his roughly $13.5 million in stock was more than enough for him to retire on. Either way, I'm sure we'll learn a lot more about the leadership transition on the conference call set to take place next month. And until we get some additional information, I don't think that there's any reason to get worked up just yet. Now, if you're someone who's worried about this, it's important to keep in mind that a quality CEO stepping down doesn't necessarily mean that the stock will perform badly. I'll end this segment by pointing out this graph of when Bill Gates stepped down as the CEO of Microsoft in 2008. Since then, Microsoft has gone on to become an incredible performer for investors, despite how scary it was at the time to see the founder and CEO leave the company. As for the rest of the market, well, Goeasy's scenario is fairly unique and probably isn't going to be a good predictor that other high flyers are set to come crashing back down. Though it does provide a good precautionary example that unexpected things can pop up out of seemingly nowhere. And if you're buying the top performers at all-time highs, you might be setting yourself up to experience the worst of a potential crash. Noting that there have been plenty of times in the past, especially over the last decade or so, where these same cautions were made and the market roared on. It's incredibly difficult to predict whether or not a crash is going to happen, and the factors that do end up causing major crashes are rarely ever seen in advance, and oftentimes are only predicted by very few individuals who are more often wrong than right. So I'm not going to toss my 2 cents into a machine that's heavily rigged against me. Instead, I'd recommend playing your own game by investing in the companies that you know well and that are offering you a reasonable return on your investment. And over the long run, you'll likely have something good to show for it, assuming you invested using conservative future projections. As for the short term, anything can happen. And taking a look at how I invested last month's $100 plus dividends, results were mixed. The smaller of my 2 investments was into MTY Food Group, which declined another 3.1%, continuing on the streak of negative monthly share price performance, despite no major news having come out. As for my other investment in the month of June, the Morguard North American Residential REIT increased by about 1.2% and paid out a solid $8 in dividends, which I'll be able to invest a little bit later on. Unfortunately, despite Morguard pulling its weight, June turned out to be a pretty mediocre month for the portfolio. As of recording this, my portfolio is still in the negatives by about $82.65, or 2.64% on the $3,125.67 that I've invested, which does include the reinvested dividends. However, if we don't include the reinvested dividends and only look at the money that I've personally put into the investment account on Wealthsimple, the portfolio is up $43.03. Taking a look at my portfolio versus the benchmarks, it's fair to say that June wasn't just mediocre for me. Most of the benchmark ETFs also had unremarkable performances, except for the S&P 500, which once again put up a very strong 1-month performance, despite having already been well ahead of the other benchmarks, now closing in on a $1,000 gain. My portfolio, on the other hand, represented by the green line, had a negligible tick downwards and is still in last place. Though if Goeasy had decided to wait till Monday to make their big announcement, then maybe that green line would be moving in the other direction. But here in this reality, I'm still trailing my goal, marked by the red line with stars, representing an annual 12% return on investment. But I'm not ready to call it quits just yet. In terms of investing, 2.5 years is just a blip. With my portfolio's holdings looking very discounted, I still think that there is a strong likelihood that I'll be able to turn things around over the coming years, especially if I'm able to continue getting shares like MTY's at a price to free cash flow multiple in the mid-single digits, and shares like Morguard at well below half of their net asset value. As for Goeasy, again, like I said earlier, I'm going to hold off on it this month, mainly because I don't know what's going on with the whole CEO situation, and while I'm not really concerned that something bad has happened, I would like to have an idea of what's going on before I decide to put more money into it. Unless, of course, it takes a much larger dive downwards. So, getting into this month's purchases, which are being shown on screen now, I was able to pick up 4 shares of the Morguard North American Residential REIT for $15.79 each, and 1.0183 shares of MTY Food Group at a cost basis of $44.05 per whole share, leaving my portfolio with no cash left over after my orders were filled. And yes, there was a weird glitch on Wealthsimple again this month, this time requiring me to log out and then log back in after purchasing my MRG shares in order to update the amount of money that I had left to invest in the account. Hopefully they get a handle on this issue for next month because it is inconvenient, and to be perfectly honest, it's bound to screw me up at some point if it persists, but hopefully it'll just inform me that I don't have the sufficient funds or something like that. Anyway, as of the market close on Friday, July the 5th, the portfolio has 138 shares of the Morguard North American Residential REIT worth roughly $2,151, about 14.6 shares of M2I Food Group, worth over $636, and the same 1.62 shares of Goeasy, which are now worth roughly $293. Moving over to the dividend tracking chart, in June, the portfolio brought in $8.02, all of which came from Morguard's monthly distribution. And this was the low month in the quarterly cycle, so it's nice to see that even when the dividends are slow, the portfolio still brought in enough dividend income to afford some hot dogs and buns that we can throw on the barbecue to celebrate the summer months around someone else's pool. Seriously though, pool upkeep costs are insanely high. I had no idea. Anyway, while our hypothetical Canadian isn't making huge waves, the cumulative dividend income earned for the year so far is definitely making a splash, as this month's $8 pushed 2024's total to just over $53. That puts us at over 40% of the way to the goal of hitting $130 in dividend income for 2024. And with next month projected to bring in $10.16, we're really making great pace, and we appear to be on track to reaching that $130 mark. Taking a look at the yield on cost, as of this moment, if I were to just leave the portfolio as it is and collect the dividends in cash for the next 12 months, assuming no additional dividend hikes or share purchases, I can now expect to receive $126.09, which is a 3.36% increase from what was expected last month. As for the portfolio's percentage yield on contributed capital, this month it has remained the same at 4.07%. And that's going to conclude this month's episode. So thank you all for watching, but before you go, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities. So again, I am not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing it with anyone else who may also benefit from it. Thank you for watching all the way to the end, and enjoy the rest of your day.